We're often asked if stocks perform better under a Republican or a Democratic president. Presidents get a lot of the blame and take a lot of the credit for the performance of the stock market while they are in office. However, the truth is that a president's ability to impact the economy and the markets is generally pretty indirect and marginal. It's Congress that sets tax rates, passes spending bills, and writes laws regarding the economy. And when looking at the stock market returns under each president, it's clear that campaign promises don't dictate the stock market the way people may think. So here's a chart going back to 1950 showing the S&P 500's price change over each 4-year presidential term. You can see that only 2 presidential tenures have even seen a losing stock market. And those negative returns can mostly be attributed to historical anomalies rather than inherently bad economic policy. Richard Nixon's resignation, 9/11, and the global financial crisis. Furthermore, the S&P 500 has averaged a strong 10% a year under Republican presidents, but a stronger 15% a year under Democrats, hopefully debunking the myth that Democratic administrations cause stocks to underperform. Now, when it comes to Congress, stocks have actually done best when the House and the Senate are split. Investors dislike uncertainty, and a split Congress means more checks and balances and less drastic change. As you can see here, when Republicans have controlled both chambers in Washington, the S&P has gained 13.4% per year on average, while GDP has grown 3%. Conversely, when Democrats have controlled both the House and the Senate, the economy did a little bit better, with GDP growth at 3.3%, but the S&P has gained 10.7% on average. But the average S&P 500 gain with a divided Congress has been 17.2%, with GDP growth of 2.8%. Again suggesting that investors may prefer split power come November. The overall theme here is that historical stock market returns do not favor one party versus another. So don't let your political ideology rile up your emotions and influence your decision making when it comes to investing. Instead, work with a CFP professional to devise a personalized financial plan, stick to that plan, and be honest with yourself about your risk tolerance.